Good evening, everybody, and welcome to F Street's webinar this evening on the best real estate investment strategies for our upcoming year, 2025. It's hard to believe that we are in November with almost 35 or 40 days left. I think it's 40 days left in the year. 2024 was a great year. I hope you all had a great year. 2024 was a wonderful year for us at F Street and our growing team. So we'll talk more about that in a little bit. A little bit about F Street. If you are not familiar with who we are an alternative real estate firm focused on building long-term wealth and wealth for our investors through passive alternative investment income. We're planting money trees. Money trees always intrigued me as a little kid. Where does the money come from? My mom always said, out back at the money tree. We remain bullish about the future of alternative investments. A lot of people ask me, what are alternative investments? Alternative investments are just simply alternative investments to standard and traditional stocks, bonds, equities that you are familiar with in our normal coerced but traditional form of investing. Whether you're 401k, your IRA, you're probably accustomed to mutual funds, Vanguard funds, some fund that is easily and accessible to you. Alternative investments are equally available to you. It takes a little bit more energy and effort. You're making that energy and effort this evening to be part of this webinar, and so you obviously are interested in alternative investments, and alternative investments will continue to outperform the markets, and we are really excited about continuing to invest. Our alternative platform is focused just on real estate. We focus on three categories: multifamily, industrial, and private debt. Private debt, private credit. In the industrial category and in the multifamily category, we both buy and build. We buy value add opportunities. We build ground up. And we'll talk more about those investments as we get through our webinar this evening. If you do have any questions or have any thoughts or any topics you'd like to discuss with me, this is a two-way webinar. Feel free to drop the information in the chat, and Peter, who is moderating this evening, will be happy to share that information with me. I will read back the question, and then we will have a discussion. For those of you who are not familiar with F Street, this is our team. Our team is mighty, small, mighty, and fierce. Maybe you've spoken to Brian, or you've spoken to Mitch, or you've spoken to myself, or my partner Josh, or Nick. We all, or Lane for that matter, we're all actively involved in our business. All of these folks check in every day here in Milwaukee, Wisconsin, at our offices that were just completed. We really have a wonderful team, really dedicated, committed people focused on making sure we're delivering unbelievable alternative investments. So thanks for being part of it to my team. And if you have any questions, they're always available as well. A little bit about our portfolio. For those of you who don't know who we are, as you can see, we've built some of the apartments on the left side. Greenlink, we just completed 2 years ago. We just started a new 156 units across the street. Tannery Falls within Sheboygan Falls. Coast, which is part of a 66-acre master plan development, has completed, and yesterday we just started phase 2 there, which we'll talk about. We do have some other conversions of value add on the right, which are ground up which are value add opportunities. We convert hotels to apartments. We've done that 6 times in Mississippi, in Texas, in Wisconsin, in Ohio, and Albany, New York. And then you can see some of our new projects we're starting. The Emory, which is under construction, 105 units in West Bend. We have the Village 43, which is the 156 units in Brown Deer I just referenced. Ivy Townhomes, 28 units as part of Lakeshore Commons, which is almost completed. So we've got a wide breadth of units that we own and are really part of our portfolio. All of these have been syndicated and are all part of our investor network. We have 1,155 units at about $200 million of value. We have 2.1 million square feet of industrial at $155 million of value, and commercial of a little over 600 square feet at $32 million of value. We continue to add this coming year. We'll double the amount of apartments that we have, and we should hopefully double the amount of square footage that we have in industrial. So we're active. We're actively finding opportunities. We're actively seeking alternative investments, and we're actively looking to share this with you. We just completed a raise on Granger, which happened in 1 week. We raised for an acquisition we're closing on December 13th, and we'll talk more about those types of deals as what 2025 should bring. So 2025 real investment strategies, what to look for in 2025 and beyond. As just a editorial for my own self, I'm extremely bullish on the two categories that we invest in, which are multifamily and industrial. We have seen a significant pickup in leasing demand on the industrial side. We remain very bullish on the ability to place these spec buildings that we bought into service before the end of the year, and we plan to. Our plan will be to develop the rest of our multifamily land, our industrial land that we have available in the commerce parks into additional industrial opportunities. Stay tuned for those, but we are really excited about industrial. We do see great credit flowing through the marketplace, and demand for leasing space remains high. Large corporations are active right now, and we're seeing a lot of movement in the marketplace. We do see the same thing in multifamily. We believe there still remains a housing shortage. In the last year and a half, a lot of multifamily developers have put pencils down due to rising interest rates. We have not put our pencils down. We've been competitive by going back to the municipalities and asking for TIFs or financing, tax incremental financing, which has allowed us to continue to put shovels in the ground. So supply, demand, it's the basic form of economics, but it remains really strong in our categories that we continue to invest in. So shifting market demand, we continue to see the market being crazy, right? We originally talked about interest rates, moving interest rates. We anticipated seeing 3.5% to 3.75% on the 10-year. That has moved the opposite direction. We're moving in the wrong direction, mid-fours right now on the 10-year. A lot of what we do is tied to the 10-year or to SOFR, which replace LIBOR, and so short term is SOFR, LIBOR. So the short-term market, as you hear, the Fed dropped rates, that really impacts short-term money, which is on the SOFR market. And that impacts our other businesses, which is our private credit and our credit facility. What it's done, though, is it's created this massive inversion into the long-term markets. And we're seeing what was supposed to be a 3.5 to 3.75% long-term market is now low fours, and should stabilize somewhere between 4 and 5. So all of the predictions that were in the threes are no longer predicting that, and I think we'll start to see a stabilized market probably in the low fours, which we hope happens in the near future. We obviously have a presidential change, and we will see policies changing, and we do see a continued shift in demand as interest rates for the 30-year mortgage remains above 7 right now. Buying a home is not affordable to everybody, and renting remains a top priority, and we still see 95% occupancy across our entire portfolio. As far as target opportunities, we focus on areas with the highest potential for investor returns. We're an investor-based company. We focus on investor returns. We are looking and evaluating at deals. We are writing an LOI, which is a letter of intent, on a multifamily or an industrial deal every single day. So we are canvassing our geographical area, which is the greater Midwest region, to acquire opportunities. We're writing offers on these or letter of intents every single day to be able to share and make sure that we can deliver above market returns to our investors. So navigating the F Street portfolio. As I said, we focus on 3 areas, which is really acquisitions, ground up development. Acquisitions is really value add acquisition. So we're looking to find an opportunity under an acquisition category where we can either find a distressed physical asset where we have to make improvements to it, find a distressed lease or economic environment, or there's some other value add where we can make improvements to increase always the NOI or the stabilization of the property. We do obviously build ground up development, and our private debt fund really focuses on a steady, consistent 10% return, which we'll talk about a little bit later. We obviously focus on making sure that you, the investor, are able to sleep at night. So we want to make sure that you're investing in what fits your expectations as well as what we can deliver. We're very transparent. We want to make sure that we can deliver on everything we're saying. And so we provide a very transparent form of investment for you to consider. Investors cross the platform of risk profile, and you've got to be sure you understand what your risk profile is that allow you to be comfortable with the investments you're going to make. And once you figure that out, we know that at F Street, we're going to deliver for you. So matching risk and return on your goals. So we believe diverse profiles are the way to think about it, right? I always tell people, invest in everything. Whatever your investment category is, make sure you invest in everything because it helps you to diversify, and it also helps you to understand who you are as an investor. Knowing who you are as an investor is a new concept for a lot of people, because most people are securities or mutual funds or 401k investors that just are very accustomed to whatever you've been told to do since you were a kid. Go make an investment in bonds, stocks and bonds. I don't own any bonds. I'll never invest in a bond. I don't think bonds are for me. I think the risk profile is way too low, and the opportunity in the marketplace I can beat all day long. So I don't even consider a bond as an investment. But a lot of people that we have as investors consider them investments. They come into us with a massive bond portfolio, and I'm always wondering, how did you learn to do this? And it's almost a book that they've been written, they've been taught. So think about what you're doing and make sure it fits what you do and who you are. Diversify across all of our portfolio is one thing that a lot of investors do. A lot of people invest in our PDF, which is our private debt fund. They invest in our acquisition of ground up industrial multifamily, and then they invest in our value add. So with that, that creates a lot of diversification. Yes, it's all with one sponsor, which is F Street and myself. But you have to think about it as you're diversifying across a complete platform that gives you various different returns, which we'll talk about in a little bit. F Street helps you match your goals to the right opportunities. Understanding what your goals are, where do you want to be in 3, 5, 7, and 10 years with your investments is really important. For me, I always like to think about it as plant all of these various money trees. My drawing's not good, but if these are all money trees, this is a 3-year money tree, this is a 5-year money tree, this is a 7-year money tree, and this is a 1-year money tree. Well, if you're willing to continue and you're going to be working for 7 more years, you can make all of these investments in the 1, 3, 5, 7-year. And then when you finally get here, all of these are going to start producing returns for you. And that really is when the moments become aha for everybody. And it far exceeds the market to a magnitude that I don't know exactly how much it will be because I can only go off of what our pro forma numbers are, and I can't read the future, but I know that we're going to be in a really good spot, and you'll be in a really good spot, not only by way of income, but also with tax. And then obviously build a portfolio that complements what your appetite is. Don't invest if you're going to stay up at night. Investing should be fun. It should be rewarding, and it should be something that lets you sleep. So long as you're comfortable doing that, you should be able to make alternative investments. And at F Street, we provide you with the transparency, which is updates and constant communication, which allows you to feel good about and to understand where your investment is at any particular time. We also have a portal, which I'll show you at the end, which allows you to see your investments in real time and understand exactly where you are. So a little bit about our strategies. F Street Strategies is in the industrial acquisition. I believe 2025 is going to be a huge targeted opportunity for us to continue to acquire value add opportunities in the industrial category. The industrial category has a very good track in terms of cap rate or risk associated with the market conditions. So as interest rates stay elevated today, cap rates in the industrial space are somewhere between 7.5 and call it 8.25. We're seeing all of that move consistently in the industrial space, and that gives us an opportunity to make acquisitions. We also are seeing below market rents on some of these large facilities, which is really great opportunity for us to buy them, to ultimately release them either to the existing tenant or to a new tenant and increase the NOI, which increases the value. We just are about to close on F Street Granger, which is on our website, and you'll see that we're buying that at a below market rent. We have a really nice tenant in there that's growing rapidly, and we think that either that tenant or a new tenant will be one that will, at the time the existing lease matures, be able to provide us with a huge upside and we're confident we'll be able to deliver on that. And then obviously in the industrial category, as part of the distress part of it, we're able to get triple nets, or the ends, which are the three ends, which are the triple nets, where it allows us to pass on the expenses of the building to the tenant. So long as the lease is written properly, so long as the understanding between tenant and landlord is correct, all maintenance and repairs traditionally are that of the tenant, so there's no unexpected deviation in cash flow. On the new buildings that we have, we're building new buildings that have warranties, but the tenant still is responsible for the maintenance and repairs, as well as the maintenance of the daily and weekly and monthly of the facility. So there's a lot that goes into stability through these leases, and these tenants that are moving in understand they're paying what they call triple net expenses, or CAM, and we are able to do that and then level out what is your distributable cash flow. This is the pending close that we're talking about here. We have this is Granger right here. If you look online, this is our pending offering. It's fully subscribed. We have another one that we just put under LOI today that will be coming out, that will be available for offering. But this is investors receive an 8% cash on cash return with a preferred return of 7%. And so here's what the returns look like. Okay, here's what you can look like from your returns. Total cash on cash is increasing as the tenant's rent is rising. We're paying a preferred return on this particular transaction at 7%. And so that pays out this $215,000 in 2025, and it goes down, right? So we raised $3.1 million. We're fully subscribed, 100% subscribed. This is coming. But as we pay back the return of capital, you can see the interest rate starts going down, the preferred return. So preferred return, for those of you that don't understand it, is the money that we pay as a preference on the outstanding capital that's there. So as we're returning $3.1 million, first year we returned $58,000 of it, our obligation on the preferred return goes down, and therefore we're paying $5,000 less of preferred return. The total distribution, though, the total distribution to the investors goes up, because we are paying back to the investors all of the cash flow to get their money, their investment, paid down. And so that's why the cash on cash starts at 8.83%, but it actually finishes 3 years later, 4 years later at 11.29%. In addition to that, what you have to recognize is you're getting we're going to do we're going to do a cost segregation study. So you're going to get 40% of your investment as a forward accelerated depreciation, and you're an owner of the asset. So once we release it, re-tenant it, or sell it in 5 years, you participate in that upside. Great opportunity. All along, every single month, you're getting a distribution from the cash flow we're receiving. So what does it look like? These are typical structures, okay? So understand how it works. You are this color, right? Which is the orange, but to me, it's not really orange. So I said this color because it looks orange on one screen, and on my screen, it looks yellow. And on this screen, it doesn't have the same color. So sorry. We give a 7 or 8% preferred return. How do we determine the number? It's all based on what we have to hit for metrics under our cash on cash returns. We want to make sure we're delivering above market rate cash on cash return, and that then backs into what we issue from the preferred return. In addition to, we want to make sure that we're issuing out what market is. So in this case, for the $3.1 million, we gave 7%, but some of our deals are at 8%. Here's one of the very interesting things about our F Street deals, okay? 100% of the free cash flow goes back to you, the investor, before I ever participate. So some people do this. Some people will say, okay, you get 60% of the cash flow, and the sponsor, gets 40%, and then this investment turns into a 20-year investment, but I'm going to sell it in year 7. Okay, we don't subscribe to that. We do it a little differently, because remember, my goal is to plant those money trees for you. So I give you 100% of the free cash flow until you're paid in full. If you put in 100 grand plus 7% preferred return, you're going to get your 100,000 plus your 7%, 100% back to you, 100% paid back to you before I participate in any of the cash flow. So then we contribute, we participate, sometimes 50, sometimes less, sometimes less. It just depends on the deal. But I don't participate. I don't touch any of the cash flow until you have 100% of your money back. So my incentive is to make sure that I am finding the right deals, that I'm finding deals that can produce cash flow back to the investors, and that I can pay you back in as quick of a period of time. Otherwise, I don't participate. Very important distinction. So we talk about ground-up developments. We do this in both categories under our strategy too. We do this in industrial and we do this in multifamily. So in both of these categories, the construction timeline is, first of all, this is a more risky investment, but it has a little bit higher rewards with significant upside once we get to the finish line. So what are the risks? Well, we have construction risks, right? I have to still build the building, right? Whether I'm building an industrial building or a multifamily building, I still have to do something. So I have to pick the right contractor, which we're 100% record with. I have to make sure I deliver it on time and with budget, which I'm 100% on right now. And I have to make sure that I'm working with the right partners so that I can finish the project and then lease out the project, whether it's leased to industrial or leased to multifamily. In exchange for that, the higher reward is that you get a better upside of return traditionally, and but it takes a little bit of time. So during the construction phase, I have no money to produce cash flow, so your return is preferred. It is accrued. In the other scenario, value add, it's paid current, meaning every month I'm making you a distribution. So one of those things that you have to just get through is that once I finish the construction cycle, if it's an industrial building, I have to finish the construction cycle and then lease out the building. And that could be a 12-month build cycle and a 12-month stabilization cycle. In a multifamily space, it's 12-month build cycle, 12-month stabilization cycle. Sometimes that can get shrunk down. But in the multifamily space, cash flow should start because I'm leasing unit by unit by unit. In industrial, traditionally, I'm looking for 1 or 2 tenants, and I have to be able to find those. So I have to make sure I'm picking the right markets. I'm partnering with the right team. I'm making sure we're on budget and on construction. And so, and on time. And so all of those play into essentially what we're evaluating when we're picking our ground-up developments. And then you might have to wait, which is the delayed returns. Your returns don't go down. Your cash doesn't go away. You just don't get it until about 2 years after the process. So you have to have patient money. You have to have money where you're planting those money trees, and year 1, year 3, year 5, and year 7, you're comfortable waiting, because each time you do this, it takes a period of 2 years for the investment to mature. So think about where you're comfortable with and what your investment cycle is. Are you comfortable making an investment today and in 2 years getting your money? Yes, you should be, so long as us as the sponsor are making sure you're getting updates on the construction cycle and making sure everything's happening. Crazy stuff happens in these developments. The craziest you can imagine. We're doing a ground-up development of multifamily. The city showed us a map. This is one of the crazy things. Showed us a map where the water is, and water goes into the site. Well, there's no water into the site. So that cost us $100,000 out of our contingency. Our investors at the end of the day don't really get to know that because it's not really their problem. I have allocated a contingency to make sure that I can solve that problem, which we were able to efficiently solve for. So sometimes you have to revalue engineer during the process. In this scenario, we were in good shape because we have enough contingency in our budget and we were able to move on. That was a problem that happened yesterday. So why multifamily development works today? How many people are amazed at the multifamily developments throughout the country? I am. Everywhere I go, I see cranes, I see development. I'm always mesmerized by who's moving into these properties and what's happening. There is a shortage of housing in our country. That is a true statement. Housing demand continues to cause the huge upswing in multifamily. Multifamily also is a really stable asset class, right? It's been resilient through economic cycles. It continues to offer consistent returns. There's huge demand to build, and there's communities that are really looking for brand new housing stock. For example, in Brown Deer, Wisconsin, where we're building right now, before we built our other building there, the last building was built in the late 80s. So they haven't had any new development in almost 40 years till we came through. And then high rents and strong occupancy ensure the long-term viability of these deals. We continue to see rent demand increase and pricing increase. We're seeing 3 to 9% increases year over year at our projects today. There are certain markets, take Fort Lauderdale or take Miami, that have probably plateaued, but they got all the way into the low $4 a foot. Just to give you a comparison, Milwaukee is, well, the suburbs of Milwaukee are about half of that. Some are a little bit higher, and then downtown Milwaukee sometimes rivals it because construction costs, while it's in Milwaukee or Miami, still are very expensive. So phase two of Summit. So we just broke ground yesterday on phase one of Summit, which was the south building. We are offering, which will be available in March or April of 2025, phase two, which is F Street OCLV MF3. This is the legal name that you can consider investing in. This is in a very proven area for us. This is part of our Lakeshore Commons. We are building an additional 58 units that are going to attach to the other 74 units that are being built as part of the aggregate buildings of Summit. So we broke Summit into two phases, north and south. Construction on the south phase has just begun with Stevens Construction on Monday. And this phase will begin in March or April. We will be raising about $6 million of equity for this. This will be a 2-year cycle once again. We strongly, the demand in this market is unbelievable. Our first phase, which is Coast, started distributing. We leased up in 8 months. We were 5 months ahead of schedule, and we've already started distributions. So during all of the craziness, we still are making distributions, and investors are still getting returns on their investment. We are very conservative when it comes to making those investments to make sure that we don't have to write you a letter telling you we've suspended distributions, but we want to be able to continue to build and lease these units. This is an unbelievable community right on the beautiful shores of Lake Michigan. Very strong opportunity. What does it look like? It's an 18.42% IRR based on a 5-year hold. We're projecting our average cash-on-cash returns. Remember what our cash-on-cash started with? It was in the 8s. This is at 10.16 based on year one NOI and incentive. And when we sell everything, if you put in $100,000, you should 2.01 exit or get $201,000 in 5 years. That's what we're projecting based on the equity multiplier for phase two, which is F Street OCLV MF3. It'll be on our website. It's on our website. You can jump in there and make a reservation, reserve your space, and let's talk if you have other questions. So investor returns on this transaction. So we're raising $5.6 million. Excuse me, we're raising $6.35 million. This is incorrect. We're raising $6.35 million. We are doing an 8% preferred return. As you notice on the other ones, it was a 7%. This is an 8% preferred return. And we do have splits set up at 65-35 back to the investor. Remember, we showed a 50-50. This is a little bit different. Investors are getting a higher rate of return because I need to be sure that we're giving you an above market rate of return, which we're doing. As you can see, you still get 100% of all the cash flow. And to my favorite fund, because it's the first one we ever started, is our high debt, is our strategy 3, which is our high yield private debt fund. We've been paying 10% returns for almost 16 years. So we pay 1/12 of 10% each month. That's if you do not select the compounding interest, which we'll discuss in a minute. So you're going to get 10% on your money every single month. Your investment is secured by our short-term loan that we take your money and we lend it out to other real estate investors at 15%. So we secure our position with a first lien position on the property, and we have a minimum hold period of 12 months for your investment with options for flexible options for repayment thereafter. So this fund has added $24 million in 2024. So what it shows is that people are seeking 10% return, and we are adding we've added a little over $2 million each month, every single month. And we've almost completed our raise of $25.5 million for this year. We will for sure hit 24, but we are well on our way to hit 25. So let's talk a little bit about it. here's how it works, right? It's really simple. The reason I made it really simple is because when I was started in the business and I was just getting started, I wanted people to give me their money. And this was the way I did it. So people would invest $100,000. They get $833.33 every single month. On the last business day of each month, we ACH the money into your account. I've never missed a payment. I've never missed a payment. I've never stopped payments. I've never missed a payment. I've never stopped payments. Payments are always made. We have never not been profitable in a given month. And as a result, you want me to be profitable. You want us to make money. As a result of us always being profitable, I always pay you. It's a pretty simple business. At the end of the day, you get a 1099 INT. And after you've given me 1 year, you have a two-way call provision, which allows me to give you back your money with 90 days notice and allows you to ask for your money back within 90 days. It's super simple. So Albert Einstein dubbed compounding interest as the eighth wonder of the world, right? Which he's spot on. My team and I have been working really hard to release this, thanks to one of our investors giving us a little push over the finish line in June of this year. We released compounding interest. You can see the power of compounding interest and the value of your dollar if you allow it to compound. It's material, it's real. You're basically earning interest on your interest. And that is an unbelievable, powerful way to make investments. If you are a high net worth individual who does not need the money today, remember, we're looking for 1, 3, 5, 7, whatever it is. Let's just say 7 years from now, and you choose compounding interest, your dollar is going to become so valuable at this is year 5, but let's just extrapolate out to year 7. You're going to have such a large amount of dollars in year 7 as the compounding interest takes hold. As you can see the difference is material. In year 5, per $100,000, you have an extra 14 grand. Just do the math. It's unbelievable. So comparing your options, we like to sit in front of you and let you drive the bus. We're here as advisors, not technical advisors, but we're real estate investors. We're investors. We invest. We love investing. That's all we do. Every day I wake up, I look at all the opportunities we have to invest, all the deals we get to look at, all the opportunities we get to do ground up, and then I look at our private lending. If you're looking for immediate cash flow, you want industrial acquisitions and you want private lending. If you're looking for long-term equity, industrial acquisitions. Multifamily development, you see what's missing is that I have a delay, and the same thing with industrial developments is the delay is there 20 to 24 months. You can get a 10% return here, or you can average a 10% cash on cash return here. So what I always tell everybody is please diversify. Please make sure you're diversifying across the platform, because the platform, if you're looking for steady Eddie, this is the steady Eddie. This has been here. I know there's some people on here who have been investors who are investing in our private debt fund who can vouch for it. If you go onto fstreet.com and read our Google reviews, you'll see folks that are receiving money. We have a long list of references that I can share with you. They have never missed a payment. I have never missed a payment. They've never missed receiving the payment, and it is unbelievable. If you look at our industrial acquisitions and our multifamily developments, we have a flawless record. We continue to work hard in all the categories. You should be managing your portfolio to make sure you're diversified. Diversification is a phenomenal opportunity, and I would strongly recommend you diversify across our portfolio and any other sponsors that you're comfortable with. I always say that because there are other qualified people out there, and I don't want to ever knock them. I know how good we are, and I know what we deliver to our investor and our investor community, but I will strongly recommend you diversify across everything we do, because I don't know when we're going to hit the home run. I don't know when someone's going to come by on any of our real estate deals. And in our private lending deals, private lending space, we're continue to add money, $2+ million a month, because people have proven the demand for a consistent, steady 10% return does not fail year over year, and we continue to grow that business. So I mentioned a little bit about our portal. Transparency is very big to me. I want to make sure that we are transparent to you. We provide material updates to everybody. We'll help you find the perfect mix. Talk to us, ask questions. If something I went over tonight doesn't make sense to you, ask about it. Let's have a discussion. Let's figure out what makes sense and what you don't understand. You can't know everything, and that's not your job, but your job is to ask questions that you don't know. Some of you are lawyers and doctors and contractors and builders and doing all other stuff. You have stuff in your industry that we don't know, and we'd love to learn about it. So please ask the questions. Our portal is at fstreet.com. It's free. It costs you nothing to sign up for it. You get your dashboard. Your dashboard shows all of your investments. This is a portfolio. They have 7 investments. They're invested in these assets. They have $315,000 invested. They've received $559,000 in distributions. We've returned capital of $29,000 and return on capital of $29,000. They have an equity balance, which is this number minus this number. It gives you your equity balance. It shows you everything here. All of your documents, all of your investments, all of your documents, everything is available to you. You can invest right now through the platform. The platform is super easy. We do require you to be a third-party verified accredited investor, because we do all of our offerings under the 506C with the Securities and Exchange Commission. The SEC has distinctions, the 506B, the 506C. Since we do advertise, we do require it to be done. They require it, and we make it seamless to be done through our portal, through the 506C, which is a third-party verification, which is done through parallel markets. So, as I say, this could be your dashboard. If you'd like to set up a 30-minute call, please do so. It's 30 minutes of your life. I promise you it'll be material, and it will change your life only in a positive way, and it'll give you the diversification you're looking for. And then, as I mentioned, everybody does need to be accredited. This is an important part of the world. The SEC requires you to be third-party accredited. This is a free, we pay for it, it's free. We use a third party called Parallel Markets that allows you to earn your badge. So please get accredited. If you're not ready to invest today, but you can be accredited, it's $200,000 of income per year for an individual, $300,000 for a family, and over $1 million of net worth, verifiable net worth. It requires a simple CPA or a lawyer letter. Everything's set up for you on our website, and it's super easy. If you're not ready to invest, get accredited. It lasts for 5 years. Super easy to do. So I'd like to open it up to any questions we have. If anybody has any questions, I'd love to take those right now. Feel free to ask your questions. And I really want to just say thank you for taking tonight a few minutes of your evening this evening to better your life and your financial future. Alternative investments are newer to the world. We all have been schooled on what is traditional standard investments, and some of those have worked out well, some of those have not. The people that have been making all of the real dollars are in alternative investments, and they're figuring out tax deferment. So thank you for being here. So the question is, if you choose a compounding feature in the debt fund, can you change it at a later time? The answer is absolutely. It's up to you when you want to choose it. If you do it mid-month, then following month, it will change back to current pay or vice versa. So we like to just make sure we do it at the start of a month, but you can absolutely do it. You can choose 50% of your investment to be in compounding, 50% to be in accrued. I mean, in paid current, however you want to do it. We have a lot of flexibility there. Our team worked really hard to get that done, and it's really a phenomenal opportunity. Yep. So the question is on the industrial acquisition deal, which was the Granger deal, or any of our current pay deals, do we intend to distribute money capital monthly? Yes, we intend to always distribute money monthly when we can. We do have some frequencies that go to quarterly, but we do. Most of our investments are paid out on a monthly basis to our investors. You'll get a distribution notice through the portal, which will show you the distribution ledger, and then it'll show you your portion of what you received, and then you should be able to open up your bank account and see that exact same amount of money reflected in the bank account. Sure. So the depth of the question is, can someone touch on the depth? Can we discuss the depth of F Street management? So myself, as the principal, the founder, I have over 20 years of investment. I've built and managed over 5,000 apartments. I've disposed of a big chunk of them, 2022. My business partner, Josh, is a lawyer as well as a CPA. He comes from the big five accounting firms, as well as a local large law firm in Wisconsin, who's joined us. We have Nick Young, who's also an attorney, who's really skilled in all real estate transactions, as well as deal sourcing and municipal support through TIF and TID. And then we've got a roster of asset managers and CFO and analysts and business development that are vast in terms of knowledge and experience. I think, we are a small but mighty team. Overhead is a very important part of what we do, so we have to manage our overhead. But we do have, in my opinion, the best team in the business in terms of development and acquisition of real estate. We do a phenomenal job, and we really try to make sure that transparency and communication is number one top priority for us. Tim, the question is, when will you get the depreciation? So the 179D, which is the accelerated depreciation for OCLVNT, which is what you've invested in, you will have that on your K1 in 2024. We've just completed that report, or it's being completed and will be done for your return this year. We just started leasing the property, as we just had the first few buildings. I think we have 7 leases or 7 people living in property already. So revenue will start, revenue's coming in, and we should be stabilized and refinancing probably in Q2 of 2025. Yep. All right, guys. Thanks for the questions. Tim, thanks for being here. Thanks for being an investor. I've got a few of our other investors I can see online, so thank you all for being part of F Street and joining us this evening. Listen, if you have a question or would like to talk about anything, my team is 100% accessible, including myself. We're available to answer any questions. Take 5 minutes to set up a meeting with our team. Five minutes to set up a meeting with me. Let's talk about your alternative investments in real estate and figure out how you can invest in F Street. We've got an unbelievable alternative investment platform, and I'm really proud of what we're building and continuing to build. And it gets built with investors like yourself who are taking the initiative to control your destiny and your financial destiny. So congratulations to those that are doing it. Congratulations to those who are wanting to do it. Let's get active, involved. Thank you very much for being here this evening. On behalf of myself and my entire team at F Street, I just want to say thank you to everybody, and I hope everyone has a wonderful evening and a great week. Holidays are near. Might be too early, but I still want to wish everyone a happy holidays. Enjoy your family, and I hope to see you soon.